So I want to review this topic of cash flow statement. And of course, I hope you still remember, whenever we are required to prepare a cash flow statement, we said this in the normal class, that you have to classify your cash flows into 3 categories. Of course, you remember there was cash flow from operating activities, then you go to cash flow from investing activities, then you go to finally cash flow from financing activities. So those are the things I don't have to remind you, because we are doing this question after discussing the topic, So I want to project a question. So that we can do it together. I've projected a question there. Are you able to see it? You say yes. Are you able to see that question? You chat and say yes. Yes, good. So that was a question that came in December 2024. It's a question number 3, B for cash flow. So let's read the question. So the question says, number B, the draft financial statements set out below relates to Bit Whatever Limited, a public company. The statement of financial position as at 31st of October. You're given 2 columns there, for the column for the year 2024 and a column for 2023. You're given the non-current assets. They include property, plant, and equipment. You're given intangible assets. You're given investments at fair value. Then you are given inventory. Then you are given accounts receivable, cash and cash equivalent. Then you are given, among the equities, you are given ordinary share capital of 10 par value, share premium, revaluation reserve, retained profit. Among the non-current liabilities, you have the long-term borrowing and deferred tax. Among the current liabilities, you have accounts payable and current tax. Then you are given an extract of the statement of profit or loss and other comprehensive income for the year ended 31st of October 2024. You are given the operating profit. You are given finance costs. You are given fair value gain on investment, profit before tax, income tax, profit for the year, other comprehensive incomes. Then you are given gain on investment, gain on property revaluation. Then you are given the total comprehensive income. Additional information. Number 1, during the year ended 31st of October 2024, the directors of the company accepted a property revaluation report at a gain of 4.5 million. The company does not make inter-reserve transfer for excess depreciation upon revaluation. Number 2, depreciation on non-current intangible assets charged to profit and loss for the year amounted to 2,780,000. Number 3, during the year ended 31st October 2024, new patent rights were acquired at a cost of 4 million. Number 4, investments held by Bit Limited are measured at fair value through P&L or through profit and loss. Neither purchase nor sale of investments occurred during the year. Then you are required a statement of cash flow for the company for the year ended 31st of October 2024 using the indirect method according to International Accounting Standard number 7. Good. Let me now go on. Now, listen. You all know that whenever you are given a cash flow question, this is important. Whenever you're given a cash flow question, the procedure for doing it The procedure for doing any cash flow question, the procedure is normally standard. What do I mean by standard procedure? In the sense that, listen, you have to keep analyzing every item. We have said this before, that whenever you are given a question on cash flow, the procedure for doing that question on cash flow is standard. In the sense that you have to analyze every item in the balance sheet. Every item in the balance sheet, seeing how that one item will help you to prepare your cash flow statement. That's important, that you have to analyze every item in the balance sheet, seeing how that one item will help you to prepare your cash flow statement. Listen, I am not saying that you have to put down the workings for every item. No, there are some items you don't have to analyze in terms of workings. But by looking at the balance sheet last year and balance sheet this year, you can be able to tell the movement. So you have to keep analyzing every item in the balance sheet. Listen. Now, listen, another point. As you keep analyzing the items in the balance sheet, listen, you already know what you are looking for. You're only looking for the figure, but you know what you are looking for. Listen. So I have said, you have to keep analyzing every item in the balance sheet, seeing how it will help you to prepare your cash flow statement. I've also said, as you keep analyzing the items, you know what you are looking for. Listen, except for this item we normally call property, plant, and equipment, which is in the balance sheet. Sometimes you may not know what you are looking for. Listen, you may not know what you are looking for when it comes to property, plant, and equipment. But for all the other items in the balance sheet, listen, for all the other items in the balance sheet, as I keep analyzing them, I already know what I am looking for. For example, when I'm analyzing the account of stocks, I look at the stocks last year and the stocks this year, then I can be able to tell whether there was increase or decrease in stocks. If I look at the loan account last year and this year in the balance sheet, I can be able to tell whether there was additional loan during the year or loan repayment. When I look at share capital, I want to know whether we could have issued new shares during the year. So what I'm trying to say is that as you keep analyzing every item in the balance sheet, you already know what you are looking for. Except for, listen, except for this item we call property, plant, and equipment, or in other words, fixed assets. Whether they are calling it machinery or motor vehicle or furniture or whatever they are calling it in the balance sheet. Some books will also only call it property, plant, and equipment. Listen, for this item, there are several things that the examiner may not give them to you. The examiner may not give them to you depending on the question. So it's upon you to find out from this particular question or whichever question you are given, what among the items in the case of property, plant, and equipment am I not given? For example, one thing that the examiner may not give to you is the amount we say or we call the cash paid to acquire new fixed assets. Sometimes you are not given the amount the company paid to acquire fixed assets. You already know that you need that amount when it comes to investing activities in the cash flow statement, but the amount may not be given. In some other questions, that amount may be given, but you may not be given the amount of the depreciation charge for the year. So it's upon you to ask yourself, have I been given the depreciation charge for the year? If not, then you have to calculate it. If yes, then you don't have to calculate it. The other thing that you may not be given when it comes to property, plant, and equipment is the amount of what we call the net book value of any disposed asset. Sometimes an asset could have been sold during the year. And when it's sold during the year, then you are required to know, did we sell it at a profit or loss? That gain or loss on disposal, you normally have to compare how much you sold the asset for and how much was the book value at the date of disposal. So that you can say, if the asset had a net book value, for example, of 10 million, and you sold it for cash of 12 million, then there was a gain on disposal of 2 million. But what I'm trying to say is, sometimes the examiner may not have given you the book value. He may just have told you, we sold the asset for 12 million. So you can't tell whether you sold the asset at a gain or loss until you know what was the net book value of that asset. Hope we are together. So when it comes to analyzing the account of property, plant, and equipment, these are the three things that the examiner may not give them to you. Listen, that the examiner may not give them to you. So it's your responsibility, as we said in the main class, you remember, your responsibility to ask yourself whether you are given which one among them. If you are not given the cash paid to acquire new ones, get it. If you are not given the depreciation charge for the year, get it. Now listen, I don't have to remind you what we said when we were tackling this topic. But in most of your past paper questions, you find that there is one among the three items which may not be given. One among the three which may not be given. If you are not given any one of them, then you normally remember you had to open the account called property, plant, and equipment. Then you feed in everything concerning that account. You feed in everything concerning the account called property, plant, and equipment. Feed in everything in this account as far as the question will allow you. Then whatever is the balancing figure will be the exact item that you're not given. So how do you get it? By feeding in. Go and bring down the book value by the beginning of the year. Whatever you're given from the question, from the balance sheet last year. If there was any revaluation, maybe we revalued some assets of property upwards during the year, whatever it is, okay. Then maybe you are given the depreciation charge for the year. You know depreciation reduces the value of an asset, you credit, whatever it is. Maybe you are given that during the year, we disposed of an asset whose book value was 10 million. You come and remove it. You say your disposal, whatever it is. Then maybe you carry down the balance by the end of the year, whatever it is. Carry down the balance by the end of the year, whatever it is. And then maybe now the balancing figure is what you are not given. And from this, I can see that maybe I'm not given the cash paid to acquire new ones, and I get it as a balancing figure on this side. How much was the cash paid to acquire new property, plant, and equipment? Alternatively, if the examiner has given you that property, the cash paid to acquire new ones, he has given you that, and maybe he has not given you depreciation charge for the year, then he will give you the disposal amount. He will give you the cash paid to acquire new ones, and so, if the examiner has not given you the depreciation charge for the year, then you will again feed in all the information relating to this account, and the balancing figure, which is the depreciation charge for the year, you will get it as a balancing figure. You get it as a balancing figure. That's what we are trying to say. So it's a very important analysis to remember whenever you are doing a question on cash flow. Whenever you're doing a question on cash flow, I don't have to go back into the details of everything. I just wanted to remind you of that important analysis concerning property, plant, and equipment. That sometimes you are not told what you are looking for, or you don't know what you are looking for. Why? Because there are several things the examiner may hide to you concerning this property, plant, and equipment. Either he doesn't give you the cash paid to acquire new ones, you need it as far as investing activity is concerned, or he doesn't give you the depreciation charge for the year, you need it as far as non-cash items are concerned, or it does not give you the book value of the disposed asset, depending on the question, so that you can determine the gain or loss on disposal of the asset. Good. That being a reminder, I've reminded you in general. How then do we do the question? So I want us to do that question now. I want us to do that question, which I've said is December 2024, question number 3. So let's do that question now. This is a December question, December 2024, question number 3. December 2024, question number 3 now. So let's do that question now, having reminded you of that important point. Good. So let me project it and we read it again. Let me project it and we read it again. In fact, we are not reading it. We are just now going to do the analysis. For example, if you look at the balance sheet, we are given property, plant, and equipment. Okay, that's the first item. I've told you, you have to analyze every item in the balance sheet, seeing how it will help you to prepare your cash flow statement. So now that we are given the first item there as property, plant, and equipment, let us go through the additional information, seeing what have they given us. Listen, what have they given us concerning property, plant, and equipment? So that I know, am I looking for depreciation charge for the year? Am I looking for the cash paid to acquire new ones? Or am I looking for the net book value of any disposed asset, if there was any disposal? Because the examiner will guide you and tell you maybe there was a disposal and an asset was sold for 10 or 12 million, and yet no book value is given. Let's go through the additional so that we know what have I been given and what have I not been given. From note number 1, you can see we are told there was a revaluation gain. That's given. 2, we are told the depreciation charge for the year was 2.78 million. You can see there that the depreciation charge for the year was 2780. Good. Number 3 does not relate to plant, does not relate to property, plant, and equipment. And number 4 does not relate to property, plant, and equipment. Listen. So from this question, listen, I can see one thing, depreciation. 2, I also notice there is nowhere the additional information is telling us we sold a property called plant and equipment. Are you there? There is nowhere we are told we sold a property in terms of machines or motor vehicle or so on. Missing. Listen now. So it tells me now, listen, it tells me from this question, we don't have any disposal of the asset. There is nothing mentioned concerning disposal. So we are left with only 2 things that I am looking for. Was there cash paid to acquire new ones? Nothing mentioned. Now, was the depreciation charge for the year given? Yes. So automatically then I know that I am looking for the cash we pay to acquire new property during the year. Some other questions you never know. You may be told in the additional information number 2, during the year the company purchased motor vehicles worth 5 million. But they don't give you the second item or the third item called depreciation charge for the year was 2780. So if they don't give it to you, then you know you are looking for it. Okay? So with that idea now, let's analyze that account. Let's analyze that account called property, plant, and equipment. Let's analyze it now. So let's open the account called property, plant, and equipment so that we determine how much is the cash we paid to acquire new ones. So open that account. Open an account called property, plant, and equipment. We want to feed in all the information concerning property, plant, and equipment, and the balancing figure be the cash paid to acquire new machines. Good. Let me go to the balance sheet last year. Let me go to the balance sheet last year, and we pick the book value last year. We pick the book value last year. So from the balance sheet last year, which I hope you can see is the second column. The second column is the balance sheet of 2023. The first column is the balance sheet of 2024. We are starting with the balance of 2023. And I can see there given as 54,160. 54,160. So bring it down. Come and see your balance brought down. 54,160. So let's go through the additional information. Let's go through the additional information. What are we told? Number one, hope you can see there. Number one, we were told that there was a revaluation of 4.5 million gain. So we come and debit. So we come and say here, revaluation. I think our balance sheet was in terms of thousands. Let me confirm. Let me confirm my balance sheet. I think it was in terms of thousands. Yes. So if they revalued by 4.5, then we are using 4,500. Let's put in 4,500 as the revaluation gain. That is from note number one. We got note number two now. We want to see whether there is anything relating to property, plant, and equipment. Yes, number two, we are told that the depreciation on the non-current tangible assets charged during the year was 2780. So we know depreciation reduces the value of an asset. So we come and see a depreciation charge. Come and see that depreciation charge. That is 2780. 2780. Good. Next, we are still going through the additional information. We saw that number three, there was nothing. Number four, there was nothing. Good. Concerning property. That means concerning property. So we come and just carry down the balance. We now come and see a balance carry down. The balance sheet this year, what are we carrying down? The balance sheet this year, what are we carrying down? Let me go and check the balance sheet by end of this year. And from the balance sheet this year, I can see we are carrying down 72,475. 72,475. So we don't have any disposal. We don't have any disposal. Maybe for the sake of remembering, listen, you can even put their disposal dash. There was no disposal of an asset. Otherwise, if there was a disposal, you will put the book value there. You will put down the book value. So the only thing then I'm not given is how much we pay to acquire new assets. So let's get it as a balancing figure now. Let me get it as a balancing figure. So let's add the both sides. Let's add both sides. It looks like the credit side is bigger than the debit side. So let's add the two sides. We have that 2780 plus 72,475. So I'm getting a total of 75,255 on the credit side. 75. I minus what's on the debit, 54,160 minus 4,500. I'm left with a balance of 16, which I'm calling now cash paid as a balancing figure. That is 16,595. 16,595. 16,595. Okay? Good. That is all about the first item. That's all about the first item. Concerning the property, plant, and equipment. Good. Yes, thank you for balancing. You have given me balancing figure, Mercy. Thank you. Now, let's go and now do the analysis of the second item. I've told you, you must analyze every item in the balance sheet, seeing how it will help you to prepare your cash flow statement. Good. So from there, what's the second item? From the balance sheet, I can see the second item is intangible assets. I think they mentioned something concerning it. Let's go through the additional information, looking for the information that they gave. Which note was that? Note number 3. Number 3 said, during the year ended, or during the year to 31st of October 2024, a new patent right was acquired at a cost of 4 million. Patent right, obvious, is a part of an intangible asset. Now listen. We were given the balance by end of last year. We were given the balance by end of this year. And then we are told we acquired a new intangible asset. So why am I analyzing this account? We want to find out, listen, could there have been any amortization of our intangible asset? Could there be any amortization of our intangible assets? That's what we want to know. It could be there or it may not be there. If the account is balancing after we have entered everything, then we know there was no amortization. If there is a balancing figure, then it will represent amortization. So let's open that account. Let's open an account called intangible asset. Let's open the account called intangible asset. We feed in everything again in this account. Feed in everything in this account. And then the balancing figure would be, if any, the impairment or the amortization. They call it impairment or amortization, no problem. So from the balance sheet last year, what was the balance of the intangible assets last year? I can see from the balance sheet last year, it was 12 to 40. Bring it down. 12 to 40. That's what we bring down. 12 to 40, bring it down on the debit side. Then from there, we were told by note number 3 that we acquired a new one at a cost of 4 million. Good. So we debit. We acquired another one. So come and see a cash paid. 4 million. Our figures are in thousands. So we put it as 4,000. Debit. Then we carry down the balance by the end of the year. Balance carry down. Let's go to the balance sheet by end of this year. See what we are carrying down. Good. From this balance sheet this year, we are carrying down intangible assets amounting to 15, if you can see it there, 15,700. Good. Let's carry down that balance. 15,700. Would there be a balancing figure? Yes. The debit side looks to be more than the credit side. Debit side looks to be more by how much? So this is 12 to 40 plus 4,000. That comes to 16 to 40. I minus 15,700. That gives me an amount of 540. This is amortization. Let's call it amortization as a balancing figure. And I'm getting 540. 540 would be the amortization amount. Okay. So let's continue. Let's continue. Good. Let's go to the next one. I've told you we keep analyzing every item during the year. We keep analyzing every item in the balance sheet. Listen, I told you there are some items we shall not put down the workings. We are only putting down the workings for those items where we feel that maybe you need to calculate and you can't do it with a calculator. So you need to do the workings. Good. What's the next item as per the balance sheet? Let's see. From there, I can see after the balance sheet, I have investments at fair value. Last year, I can see the value was 5.5 million. This year, the balance sheet says 5.825. I think there was something concerning the additional information. And they are just saying Where was that? Note number 4. Number 4 said, investments held by B Limited are measured at fair value through profit and loss. Neither purchase nor disposal of the investment occurred during the year. No purchase, no sale. What does it mean? We had an investment last year, whatever they are, 5,000, 4.4, whatever. Then we have another investment this year. Then they are just saying, if the investment last year, no, let me pick it first, the balance sheet, so that you can get my point. From the balance sheet last year, you can see the investment was worth 5.5 million. This year, the investment has gone up by 5.8. So that tells me there was an increase in the value of the investment. But that increase did not occur because of buying more investment. Yes, the value of the investment has gone up, but that does not mean that we have acquired an investment. The examiner has told you neither purchase nor disposal of investments were done or occurred during the year. So it tells you the only difference was the remeasurement. That if they remeasured the investment at fair value, these are financial instruments, it was measured at the beginning of the year at 5.5. Come the end of the year, it was remeasured at 5.8. So there was a gain on revaluation of this investment of the difference. That looks like 325. 58.25 minus 5.5, that looks like 325. So that was the gain on revaluation. Listen, and they are telling you, get the point here, they are telling you that the treatment of the gain is the one to go through P&L. If you look at the additional information, they told us, listen, that this is an investment that is measured at fair value through profit and loss. Through profit and loss from note number 4. So that means, listen, there is a gain on revaluation of the investment by 325. How will you treat that gain? And by the way, let's see whether it was reflected in the P&L. Let's see whether it was reflected in the P&L, because they have said, yes, if you look at the balance sheet, if you look at the P&L account, the third item in the P&L account is fair value gain on investment. 325, good. That is what we shall treat. Listen, that is what we shall treat as a non-cash item. If there is a gain on revaluation, just like there could be a gain on disposal, that's a gain on revaluation which went through P&L. Okay? That is something we shall treat as a non-cash item. When we shall be preparing our cash flow statement, you know where we normally put in our non-cash item. But for the sake of remembering, put just the account down, put down the account, just call it investment, bring down the balance. You don't need to, otherwise, listen, let me explain. In the exam, you did not need to open this account. You just needed to analyze and say, investments last year were 5.5. This year the investment is 5.8. So if there was no purchase, no sale, that must be the gain on revaluation. I'm going to treat it as an non-cash item. Simple. That's what we are trying to say. Otherwise, for the sake of remembering, when you are revising, just put down the workings. Put down the balance. Balance brought down 55. 55. Balance carried down is the one which is 58.25. So we are saying there is a gain on disposal which went to the P&L account. Here, P&L account as a balancing figure, there is that gain of 325. 325. Otherwise, we did not need to open this account, because you could do the analysis by looking at the balance sheet and agreeing and deciding what that 325 is and how you're going to treat it in the balance sheet. Okay? Good. That's all for investment. That's all for investment. Let's go to the next item, see whether there is any workings to be done. Let's go to the balance sheet. I'm trying to analyze the balance sheet. Good. If you look at the balance sheet, the next item is among the current assets. Listen. For current assets, we have inventory, or what we can call stocks. Last year, you can see from the balance sheet, the stock was 70-40. This year, the inventory was 74-85. So there seems to be an increase in stocks of whatever the difference for something. Do I need to put down the account? No. You can still work it out as you are doing the question. Just take a calculator. You say 74-85 minus 70-40 is an increase of whatever. So that is enough for that. So I don't have to open the account. The next account is the account called receivables. Accounts receivables. If you look at the balance sheet again last year, the receivable was 58-30. This year, the inventory the receivables are what we are getting are 60-30. We have no other additional information concerning it. So there was an increase in debtors, or what we can call accounts receivable. That's okay. Next. From there, we normally go to cash and cash equivalent. Listen. From there, we normally go to cash and cash equivalent. I do hope you know that we normally don't analyze. Listen. We normally don't analyze the account called cash and cash equivalent. The way I'm analyzing property, investment, intangible assets, we normally don't analyze the account called cash and cash equivalent. The way I'm analyzing the stocks, the way I'm analyzing the data, no. You know, because we are doing this question not for the first time. We have done this topic. So we are saying we know that cash and cash equivalent has its own place as far as cash flow is concerned. And we normally use it down there in the cash flow. We normally use it down there. So I know you know that we normally use it at a particular point. So we shall not use it to analyze. We shall not analyze it the way we normally analyze the other working capital items like stocks, debtors, creditors. Though it's a working capital item, you know that it has its own place as far as cash flow is concerned. Good. So that means we don't analyze it. We shall use it in a particular place. Good. So it means, therefore, I am through with the current assets. We now go to equities. Among the equities, I can see ordinary share capital. I can see share premium. So I need to analyze and know whether there was any issue of additional shares. Good. I also hope you know, listen, I also hope you know, to know whether there was any issue of shares, we normally don't analyze the account of share capital alone. You know that. We normally don't analyze the account of share capital alone. We normally analyze it together with the account of share premium. Okay? So maybe let's put down that working. Let's put down that working. So let's open an account called share capital and premium. We want to know this company, could it have issued some more shares during the year? That's what we want to know. We open the account called share capital and premium. Share capital and premium. What we do, we bring down the opening balances. Balance brought down. One for the ordinary share capital and the other one for the share premium. The other one for the share premium. Oh, somebody's asking a question. I am joining. Which year are we doing the question? Sorry, you have already been told. December 2024. Okay, thank you. Sawa. Good. Sawa. So let's analyze now the share capital and premium. We go to the balance sheet and bring down the two balances. One for the ordinary, I hope you can see it there. 40,000, put it down. The other one for share premium, bring it down. That's 10,000. I've managed to bring down the two balances. I've managed to bring down the two balances. Listen. Listen. From this question, there was nothing mentioned as part of the additional information concerning share capital. Listen. From this question, there is nothing mentioned in the additional information concerning share capital or share premium. Listen. But there are some questions that could have told us that during the year, the company issued some bonus shares. You already know that when a company issues bonus shares, those shares are shares given for free. Listen. But whenever a company gives bonus shares, that share capital, the capital of the company automatically increases. Whether the company is issuing the shares for cash or for free, share capital normally will have to increase. So if there is a note, or if there was a note concerning bonus shares, then you will go and find out from the question, what was the source of financing the bonus? Because we are not issuing them for cash. If the question could have told you, for example, the bonus was financed from share premium, then you debit share premium and credit share capital. Or the question could have told you the bonus was financed from general reserve, debit general reserve, you credit share capital. So for this question, there was nothing in the additional information concerning share capital. So it means we just carry down the balance by the end of the year. And if there will be any balancing figure, that will represent the cash we received from issuing new shares. Otherwise, I brought in an element of bonus, which is not part of this question, but I know there are some questions that do have the component of bonus. So we carry down the balance by the end of the year, again in terms of share capital and in terms of share premium. What are we carrying down the balances? The balance sheet this year, we are carrying down a share capital of how much? 50. I can see it from the balance sheet, while the share premium is 12,500. We are carrying down a share capital of 50,000 and 12,500. 12,500. So we find that there is a balance here. Obviously, from the debit side, I can see the total is 62,500. So there must be some issue of shares during the year. That will come to the credit side. Come and see a cash received as a balancing figure. So 62, if I minus 50 on the debit, that automatically gives me a balancing figure of 12,500. 12,500. So we must have issued new shares for 12,500. You there? Good. Let's move on. Let's move on. Good. We are going on well. I hope we are together so far. Good chat and say yes. I want to know whether we are together so far. Are we together so far? I want to know yes. Good. Thank you. So let's go to the next item. Let's go to the next item. We want to analyze. Good. Thank you. Want to analyze the balance sheet. After that, I can see the next item is revaluation reserve. Let's see what the change is. Listen. Last year, if you look at the balance sheet last year, the revaluation reserve was 5,000. Listen. Then during the year, if you remember, we were told by note number 1 that there was a revaluation gain of 4.5 million. So if last year the balance was 5,000, if I add the gain on revaluation of 4.5 million, that should give me 9.5 million. Let's confirm whether it's the same balance carried out. Yes. So it automatically means, listen, it automatically means there was nothing that can affect cash flow concerning revaluation. If I may put down the account so that you see it, maybe for the sake of doing it, listen, but the point is this, so that you get to understand how to tackle questions in the exam. If I look at the balance sheet last year, 5,000, I know there was a revaluation gain of 4,500. That comes to 9,500. I check the balance by the end of this year, it's 9,500. Then I see nothing affects P&L. That means that the change in the revaluation gain will not affect the cash flow. So let's just put down the balance or the account for the sake of remembering that there is nothing that will have come from here to cash flow. There is nothing that will affect the cash flow as far as revaluation is concerned. This is balance brought down 5 million. That was the balance last year, 5 million. Then there was a revaluation of property. We come and say a property, plant and equipment, 4.5. So we are carrying down a balance of 9.5, which is exactly what we are given at the end of the year. This means there is nothing affecting P&L. Good. Let's move on. We have analyzed the revaluation. Now, listen. I hope I'm not going to be told, listen. I hope I'm not going to be told when I'll be asking you to give me non-cash items like depreciation and so on. Some of you, whenever I ask that question, when we shall be doing the cash flow, some of you give me the gain on revaluation or the loss on revaluation of a fixed asset like now. This 4.5 million is a gain. But I want you to understand, as much as it's true, it's an non-cash item. As much as it's true, it's an non-cash item, we don't use it in the cash flow statement. Why? Because when we come to cash flow, we normally start with something called profit before tax, whatever it is. Then we adjust it, listen, we adjust it with those items that went to the P&L, which are non-cash items. Those things that affected the profits, which are non-cash items. When we shall be preparing the cash flow under the section called operating activity, we normally start with the profit before tax. Then we normally adjust it with non-cash items like depreciation, gain on disposal, loss on disposal. But don't tell me that time that there's another one called gain on revaluation. Like most students sometimes tell me that. We are saying no. Why? As much as it's true, we did not receive the 4.5 in cash. And as much as it's true, it's an non-cash item. The question will be, is it affecting what I am adjusting? The answer is no. In the sense that we are adjusting the figure called profit before tax. How are we going to adjust it? We shall be arguing by saying, if the profit is 10 million and in the P&L account, you charge depreciation of maybe 2 million, we shall be asking ourselves, that depreciation that went to the P&L account was an non-cash item. If that depreciation was not in the P&L account, what would have been the true profit? We charge P&L account with the depreciation of maybe 2 million. We got a profit of 10 million. But now we are asking ourselves, what would have been the true profit for the company if everything in the P&L account was by cash? That's why we normally come and add back that depreciation. Why? Because when we included depreciation in the P&L account, and yet it's an non-cash item, from the cash point of view, it made our expenses to be overcasted. From the cash point of view, I'm not talking of from the profit point of view, from the P&L account point of view. In the P&L account, it was well treated. But don't forget, we are not preparing P&L. We are preparing cash flow statement. So we normally ask ourselves, yes, the profit for the year was 10 million. Are there items that went to the P&L account which we never paid cash for or received cash for, so that we adjust that profit and get the true profit if everything in the P&L account was by cash. So we argue by saying, depreciation being one of them, what effect did it have on the profit as far as cash flows are concerned? We argue by saying, expenses included depreciation, it's a non-cash item, and therefore expenses were overcasted. From the cash point of view, they were overcasted. When expenses are overcasted, automatically profit was overcasted. No, was undercasted, sorry. The profit was undercasted. When expenses are overcasted, profit is undercasted. To correct it, we normally add. When you take another thing, for example, there was a gain on disposal of a motor vehicle. That automatically could have gone to the P&L account. So if there is a gain of maybe another 2 million that went to the P&L account in terms of gain on disposal of a fixed asset, yet we did not receive the 2 million gain, it is obviously a non-cash item. It is a non-cash item. Okay? So we argue by saying, as far as cash flows are concerned, what would have been the true profit in cash flow terms if everything in the P&L account was by cash? Got a profit of 10 million, but in that 10 million, there's a gain of 2 million on disposal of an asset. Yet we never received the 2 million. What would have been the true profit? You argue by saying our gains are overcasted. Now, our gains are overcasted. What effect do they have on the profit? They also overcasted the profit. Come and remove. We deduct. We say here less gain on disposal. I hope you are now getting my logic. So, the reason why I'm going through this is because I've told you, some students, when I'm asking some non-cash items, they give me that item called gain on revaluation. They argue it's a non-cash item. I don't refuse, it is. But the question is, does it affect P&L? Listen, whenever you revalue an asset, we normally debit the asset. Listen, we normally debit the asset and credit the revaluation reserve account. Whenever you revalue an asset, just like we did here, it's here, by the way, you can see here, when we were analyzing this account of property, we debited the property by 4.5 million. I hope you can see it there. The double entry for it is that you credit the account called revaluation. You credit the account called revaluation reserve. This revaluation reserve goes direct to the balance sheet. Doesn't go through P&L. So this 4.5 million, the double entry being debit asset, credit revaluation reserve, that did not affect P&L. It does not affect the P&L, the 4.5 million gain. So because it doesn't affect P&L account, it will not affect the non-cash items in the cash flow. Hope you are together there. I hope you are together there. If we are together, you say yes. Are we together there? Yes. If we are together there, you say yes. If you have understood the concept of gain on disposal, gain on revaluation, sorry. Good. Somebody is saying, I reviewed the case of bonus. Aya. Who is this? Vincent. Let me review it. I was saying this. Let me review it down here, because I don't want to mix it with the other working. Don't write this. Don't write this. I was saying share capital. We normally analyze it to help us get what? To see whether there was any issue of shares during the year. I've said we normally bring down the balance by the beginning, whatever it is, ordinary share capital. Let us assume it was 20,000. Don't write. Then I've said maybe the share premium was maybe another 5,000. Then you may go through the additional information that you're told. Listen, during the year, the company issued bonus shares worth maybe 10,000. Or you're told the company issued bonus shares in the ratio of blah, 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 this much. Listen, I said bonus shares are extra shares given to existing shareholders free of charge. That is the definition of bonus. Extra shares given to existing shareholders free of charge. But the point is, whenever a company issues shares, whether by cash or for free, the share capital of the company will increase. So this account must be credited by 10,000 because we issued shares worth 10,000 as bonus shares. The question is this now. Listen, if we had issued them for cash, shares, not bonus, if we had issued those extra shares by cash, I would have debited cash and credited share capital by 10. But now I'm giving them for free as bonus. So the question is, where will be the debit? The credit is 10,000 in the share capital. What about the debit? Listen, for every credit, there must be a debit. So it means this company must finance, listen, this company must finance this bonus from somewhere. It must finance this from a reserve. That is the requirement, that any bonus shares must be financed from a reserve account. That reserve could be the retained earnings of the company. It could be the general reserves of the company. It could be the revaluation reserves of the company. It could be the share premium of the company, whatever. So if there is a bonus element in the question, the examiner will not tell you the amount. He might tell you bonus shares were issued in the ratio of 1 for every 5 held, blah, blah, blah. This bonus was financed from, that will be told. This bonus was financed from maybe general reserve. So what do? You go debit the account called general reserve and you credit this account called, you go debit the account called general reserve and you credit this account. Then you come and now say your balance carried out, maybe 30,000, maybe for the ordinary, maybe for the share premium by the end of this year, it was maybe 15,000. Then you come and say, okay, there is a balancing figure still. So you come and say your balancing figure, cash received. In terms of you must have issued, listen, you must have issued some extra shares by cash. Other than those which were issued by way of bonus, you must have issued some extra by way of cash. You come and say this side is 45. This side is 35. So there was another 10,000 cash. Is that 10,000? Yes. Because this is 20, 25, 35. Good. So there must have been another one. 10,000 by cash. Give you 45. Vincent, are you okay now? That if there is a source, if there is a bonus element, that share capital should be credited by the amount of the bonus. But if you are not given the amount of the bonus, they will be giving you a way of calculating it. They will give you a way of calculating it. Are you okay? Good. But I'm saying the question will tell you where the source of the bonus will come from. If it's share premium, you debit share premium, you credit share capital. If it's general reserve, you debit general reserve, you credit share capital. If it's revaluation reserve, you debit revaluation reserve, you credit share capital. Wherever the source of the bonus, you will be given. Vincent, are you okay now? You asked me to review the concept of bonus. Good. Thank you. So now we can proceed. Let me wrap this now. Let me wrap this so that we proceed to our next item. So we are still analyzing, don't forget, we are still analyzing our balance sheet. We are still analyzing our balance sheet, and we said you have to keep analyzing every item after the other. Good. So we are at the point, we were at the point of revaluation reserve. Let's now go to the next one. Let's go to the next one. Let's see what are we required to analyze after revaluation reserve. What's the next one? Good. I can see the next one is what they are calling retained earnings. Now, I want somebody to tell me this. Listen. The challenge I'm giving to you, I want to see the answer. There are times, listen, there are times you don't analyze the account called retained earnings, and there are times you have to analyze it. If you have to analyze the account called retained earnings, you have to analyze it to get what? Tell me now. Somebody put it as a note. If you are to, will be required, if we will be required, I don't know, we shall check the question properly. If we will be required to analyze this account called retained earnings, for what purpose would we be analyzing it? To help us to get what? So that, listen, so that if that which we are trying to get is given, then we shall not need to analyze the account called retained earnings. I'm saying there are times you analyze the account called retained earnings, and there are times you don't analyze it. If you are to analyze it, you analyze it to get a particular item. And so, if that item is given in some questions, then you don't need to analyze the account called retained earnings. So the question is, what is it? When I'm analyzing the account called retained earnings, I normally analyze it to help me get what? Somebody put down. I want to see. Why do we analyze the account called retained earnings? Because we are reviewing. We have already done a question in the main class. Why do we analyze this account called retained earnings? Somebody explain. Good. Thank you. To determine the dividends paid. Thank you very much. That is Mercy. Good. Now listen. That is the reason why we normally analyze the account called retained earnings. To determine the dividends paid by the company. But if the amount is given, then you don't need to analyze it. Listen. How is the amount given? Listen. To know whether the amount is given, you will go back to the question. There are times when from the question, you may be given what we call a statement of changes in equity. If you are given a statement of changes in equity, then you can clearly see from the statement of changes in equity, or in other words, listen, or in other words, you may be given the appropriation of the profit. You all know dividend is an appropriation of profit. So if you are given from the question that this was the profit for the year, and this is how it was appropriated, and among the items appropriated out of it is dividends paid, then you don't need to analyze the account called retained earnings. Why? Because you have already been given what you normally look for. So we normally analyze the account called retained earnings if we have not been given how much the company paid as dividends. For example, when you look at this account, you can see this P&L account. When the company got the figure called income tax there, listen, when the company got the income tax there, they got the figure called profit after tax, which is what they are calling profit for the year. Profit for the year is the same as profit after tax. Listen, this company, once they got that figure, don't write the following, once they got this figure called profit after tax, they did not appropriate this profit in their income statement. neither are we given their statement of changes in equity so that we can see the dividends paid. So because there is nowhere dividend is mentioned or shown, then it becomes your responsibility as a company or as a student to compute the dividends paid. How? Listen, before we talk about how, let me remind you how profit is normally appropriated in a company. We normally come and say profit after tax. Then from there, we normally say dividends, whatever it is. You know this from your accounting knowledge. After you do that, you normally get what we call retained profit for the year. Then you know we normally come and add retained profit brought down. Once you add retained profit brought down, you normally get what we call retained profit carried down. That's what you normally do. If the income statement was complete, this was the section that was supposed to be added, but we can't see it. Listen, but we know from this question, we can be able to tell. Let me assume the profit was 4,000 after tax. I'm assuming. From the balance sheet this year, you can get what they are giving us as their retained profit carried down. Let's assume 15,000. That's what I'm assuming they carry down. Or let's say 25. Then, from the balance sheet last year, listen carefully, from the balance sheet last year, again, you could pick what was retained profit carried down last year, which automatically means you could know what was the brought down this year. Let's say 22,000. So listen. So if I know the retained profit carried down and I know the retained profit brought down, it is possible to get the retained profit for the year. Because we normally say retained profit for the year plus the brought down should give me the carry down. So automatically, therefore, I am working backwards. Okay? So I am asking myself, if they are carrying down a retained profit of 25, out of which 22 was for the year, was brought down, how much was the retained profit for the year? It must have been 3,000. Must have been 3,000. Good. Then you argue by saying, if the profit after tax was 4,000, out of which they paid some amount as dividend, for now we don't know how much. If the profit after tax was 4,000, out of which they paid a dividend of whatever the amount, which we don't know for now how much, and then they retained out of 4,000, they retained 3,000. What must have been the dividend the year? So you come and get the difference, which is again another 1,000. That's how we determine the dividends paid during the year if it is not given. If it is not given. Are you there? Good. I hope you are getting. If it's not given, that's how you determine the profit for the year. No, the dividend, sorry, for the year. Good. But we are saying you work what? Work backwards. You work backwards. So I get the carry down, get the brought down, get the return for the year. I compare that with the profit for the year, which is the operating profit. No, profit after tax. Good. So with this case now, listen, I was saying there are times you analyze the account called retained earnings. There are times you don't analyze it. So from this question, automatically we can conclude we shall have to analyze the account called retained earnings so as to help us to determine the dividends paid. So with that idea now, let's put down the workings. Let's put down the workings. So andika somewhere so that you can remember. Andika somewhere determination of the dividends paid. 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 Let's work backwards. We come and say a profit after tax. Let's go to the income statement and pick it. Let's go to the income statement and pick it. And from this income statement, we had been given an amount of the profit for the year, which is profit after tax, 46.65. Good. Pick it. 46.65. Then you come and see your dividends paid. Put in bracket balancing figure. To remind you, that's what we are trying to calculate. This is balancing figure. Mind you, that's what we are trying to calculate. Then we come and see a retained profit for the year, which we don't know. Then we come and see your add retained profit brought down. Let's go pick it. The balance sheet last year. Let's go pick it from the balance sheet last year. Are you seeing it, how much it was? Yes, good. I can see there the retained profit was 14,755. Bring it. 14,755. Then we get what we are calling retained profit carried down. And I can see from this balance sheet this year, the retained profit carried down is 17,505. 17,505. Good. Let's get the balancing figure to represent now the dividends paid. Good. Let's get work backwards now. Let's work backwards. The retained profit carried down is 17,500. So what's the retained profit for the year? This is 17,505 minus 14,755. So these guys retained 27,50. Hope you are getting like mine. 750. So then I ask myself, if the retained profit for the if the profit of tax was 46.65, out of which they paid a dividend or whatever, and they retained 27.50, they must have paid a dividend. Just a minute. Something is wrong with mine. Wait, just a minute. Something is wrong here. Just a minute. Let me pick the right figures. Sorry, I picked the wrong amount for the profit. Sorry. I picked the wrong amount for the profit. I hope you can see there. Somebody should have noted it. I picked the profit before tax. Are you seeing it there? I picked the figure called profit before tax instead of profit after tax. Somebody should have noticed that we are picking the profit after tax, not profit before tax. Our profit before tax was 46, yes, but after tax is 33.35. Sorry, change that figure. 33.35. Sorry. So this will change. This is 33.35. Let's work out now the dividends. So the other figures will not be affected because we were working backwards before we reach there. Good. So we come and say, out of 33.35, there is an amount they paid as dividend, and then they ended up retaining 27.50. So I can see there is a balancing figure of 585. That's the dividend paid. That's the dividend paid. Okay. Yeah, so that's a point. That's a point. Sorry, sorry, Mercy. True, we had used the profit before tax instead of dividend paid. That's correct. Let's now go on. So let's go to the next analysis. You can see these are some of the items we need to put down the workings. There are some I told you don't need to put down the workings, like stocks, datas, creditors, and so on. Good. Let's move on now. We are still analyzing the balance sheet. After retained earnings, now we can go to non-current liabilities. Among the non-current liabilities, I can see we have long-term borrowings. Listen, do I need to analyze that account? Listen, I don't think so. Why? Because last year the loan was 10,300. This year the loan is 11,600. Listen, I'm asking myself, is there any additional information concerning the loan? There is nothing which you remember we mentioned from the additional affecting the long-term borrowings. No. So automatically it will tell me if the loan last year was 10,300 and this year it's 11,600, there must have been some increase in the loan which automatically came from additional loan. So I don't need to open the account called loan or borrowings because I can automatically analyze it by taking a calculator. I take 11,600 minus 10,300, that's about 1,200. That's an additional loan. You remind me when we shall be doing the cash flow that there was an additional loan which the company received. So I don't need to analyze that account. We leave it. Next one you can see is deferred tax. I do hope you know. We normally don't analyze the account called deferred tax alone. We normally analyze it together with the current tax. And we normally analyze those two accounts, deferred tax and the current tax, to help us get what we call the tax paid during the year. So we need to analyze the account called taxation, whatever form of taxes. We need the amount you paid for taxes, whether it's the amount you paid in terms of deferred tax or the current tax, it doesn't matter. It's still taxation. Let's open the account called taxation. Let's open the account called taxation so that we see how much the company paid for taxes. So we feed in everything again. Listen, we feed in everything again in this account called taxation. Then the balancing figure will represent how much we paid for taxes. So bring down the balances first. Balance brought down. One is in form of deferred tax. The other one is in form of current tax. We go to the balance sheet last year and we pick the opening liabilities by the beginning of this year. And according to the balance sheet, I can see the deferred tax last year. The deferred tax last year was 1955. Bring it down. While the current tax down there is 1485. The current tax, bring it down also, 1485. 1485. Good. Listen, once you bring down those two balances, you go to the income statement and you pick the charge for the year. We were given the charge for the year for taxes. So we go and pick the charge the year for taxes. Let me go to the income statement and pick the charge for the year for taxes. And the charge for the year, you can see it there, is 13,330. We have deducted it. Listen, we have deducted it in the P&L account. Anything deducted in the P&L account, you know, is a debit in the P&L account. So automatically we should credit this account. So come and say your P&L account, 1330. 1330. That was the charge for the year. From the additional information, there was nothing mentioned concerning taxes. What is only remaining is to carry down the balance. One again in form of deferred tax, the other one in terms of current tax. One in form of deferred tax, the other one in terms of current tax. Let's do the same for the end of this year. We go back to the balance sheet and carry down the two balances. Our deferred tax I can see is 2370. Carry down that balance. While the current tax is 1880. Let's get the balancing figure. Let's get the balancing figure to represent how much we paid for taxes. It's normally on the debit side as a balancing figure. So I'm adding the credit side first. That is 1955 plus 1485 plus 1330. That looks to me as 4770. I minus the debit 2370 minus 1880. I'm remaining with a balance of 520 if I'm correct. Good. So let's continue. Hope we are managing to get it. How did we get 27 as dividend paid when determining? So let me go back. Somebody again, Vincent, is asking. Vincent, cut it this way. You're asking how did we get this 27? I took 1705, which is the carry down. That is the retained profit carry down. Out of which the return brought down by the beginning of this year was 14,755. So we are asking, if we are carrying down a retained profit of 17, and by the beginning of this year we began the year with a return brought down of 14,755, what must have we retained during the year? So we minus those two, which is 17,505 minus 14,755. That will tell me how much we must have retained during the year, and that is what we are getting as 2750. Are you okay, Vincent, now? Vincent, we are carrying down 17,705 from the balance sheet this year, out of which from the balance sheet last year, the retained was 14,755. So we are arguing by saying, if we are carrying down 17, out of which the brought down by the beginning of the year was 14, what must have been the amount we retained during the year? It must have been the difference, which is 14, subtract from 17, get 27. Are you okay, Mr. Vincent, now? Good. Gotten it. Thank you. We now proceed. Sawa. So let's now get to the next one. Listen, we are trying to analyze each item in the balance sheet. Listen, I hope you have not forgotten what we are trying to do. We are still analyzing one item after the other, seeing how that one item will help us to prepare our cash flow statement. Good. Let's go to the balance sheet, see what's the next item now. Let's go back to the balance sheet, see what's the next item. Sorry. Okay, fine. I am through with the long-term liabilities. I hope you can see there. I'm through with the long-term liabilities. We have dealt with the borrowings. We have dealt with the deferred tax. Then now we go to current liabilities. I've told you we normally don't analyze the account called accounts payable. I don't have to open the account. That's what I'm trying to say. Because I can see last year the accounts payable was 3505. Then this year the account is 4645. So there was an increase in creditors. So automatically I don't need to analyze that account. I'm going to use a calculator to get it. From there, the next item is current tax, which we have already done. Good. I think now we are through with the analysis. Okay. Think we are through with the analysis? Listen, before we even start the cash flow now. Think we have done the analysis. Now you know that whenever you are given a question on cash flow, the procedure for doing the workings is standard. I'm repeating. I have said you must analyze every item in the balance sheet, seeing how that one item will help you to prepare your cash flow statement. Also said, there are some items you don't put down the workings for, but there are some you have to put down the workings. Okay? That's what I've said. Where I don't need to put down the workings, use your calculator. Analyzing stocks, datas, creditors, and so on. And other items which they don't have additional information. The other key point I said was this. As you keep analyzing the items, each item, you already know what you are looking for. Except for, as you keep analyzing the items, you know what you are looking for. The only what you are looking for is the amount. But as you keep analyzing each and every item, you know what you are looking for. Except for this item I called property, plant, and equipment, where I told you that when it comes to property, plant, and equipment, that is the major thing as far as cash flow is concerned. The major tricky thing, let me put it that way. Major tricky thing that the examiner would only be testing. In the sense that when it comes to analyzing the account of property, plant, and equipment, or in other words, a fixed asset, by whatever name the examiner is calling it, whether it's calling it machinery, motor vehicle, furniture, building, and so on, there are three things that the examiner may not give them to you concerning property, plant, and equipment. One of them I said, cash paid to acquire new ones, it may not be given. 2, the depreciation charge for the year may not be given. Need it. 3, any net book value of a disposed asset. You may need it to help you get the the gain or loss on disposal. Also told you to get any one of them, if only one is not given, to get any one of them, if it's not given, then you feed in all the information in the account called property, plant, and equipment. Then you analyze the balancing figure. Whatever is the balancing figure will represent what it is that you are missing. It could be the cash paid. You will get it on the balancing figure as a debit side. It could be that cash paid is given to you as per another question. The only thing missing was depreciation. You will get it as a balancing figure, the account called depreciation. In this account. It could be you are not given the book value of a disposed asset, but you are given the charge for the year for depreciation, and you are given how much you paid to acquire new ones as terms of cash paid. So you may not be given the book value of any disposal. You get it as a balancing figure. Okay? Now, I don't want you to tell me the answer to this because I know you know. The question is this, because this question is not testing us on that, but for the purpose of just reminding you so that you research more, find out, because we have done this in the class, just to remind you. The question is this, listen, what if 2 of those things are not given? 2 of them are not given. Meaning, suppose you're not given the cash paid to acquire new ones, and you're not given the depreciation charge for the year. You're not given the cash paid to acquire new ones, and you're not given the depreciation charge for the year. How do you get the 2? I don't want you to answer me that question, because this was not the question. But in our class, we did a question where if the 2 are not given, what do you do? Remember, You cannot get a balancing figure of two items in one account. Say, some questions may not give you two. They just tell you, during the year the company acquired some new property. But they don't tell you how much. So you will have to get it. And they don't tell you about depreciation, which automatically you know there must have been depreciation. So, if you're not given two of the three things, 2 out of 3, then it becomes a bigger challenge. So I don't want you to tell me how. Just find out. Maybe you can tell me this in the next lesson. Tell me this in the next lesson. That's how do we get, in case 2 things are not given out of the 3. The problem is you can't get a balancing figure of 2 things in one account. So let me post that question to you, just to challenge you on if you are not given 2 out of the 3. If you're not given 1, then it becomes easy. Just feed in everything else in the account. Whatever is not given, get it as a balancing figure. But you're not given depreciation charge for the year. You're not given the cash paid to acquire new ones. So you can't get a balancing figure of 2 amounts. How do you get those 2 figures? You still must get them. How? I don't want to challenge. I don't want you to answer me that now. You will answer me in the next lesson. Okay? But of course we have done it when we were doing this topic. Okay? Good. So let's proceed now. Now that we have done the analysis, of each item, let's prepare our cash flow question now. Let's prepare our cash flow statement. Sorry, not cash flow. We prepare our cash flow statement now. Let's prepare our cash flow statement now. Okay. Cash flow statements. We normally start with what we call cash flow from operating activities. Cash flows from operating activities. Remember, we have done this before, so you will be reminding me some of the items. Okay, so we normally start with what we call net profit before tax. Or let's call it profit before tax. That one you know. Where do you get it? Listen. It's an amount you're always given. Go to the income statement, pick the profit before tax. Go to the income statement and pick the profit before tax. Let's pick it. Hope you can now see it there. I'm picking that figure now, 46.65. That's our profit before tax. You there? Good. We pick that profit before tax. 6.65. Then I said we normally adjust it with any non-cash item. Anything, listen, anything that went to the P&L account, yet it's a non-cash item. I've already told you one of them is depreciation. Come and say you add depreciation. That one I remember discussing it a short while ago. Why do we add it? Because you debited P&L account with a depreciation charge for the year, yet you paid nothing concerning the depreciation charge. As far as cash flow is concerned, I said, the cash flow or the expenses are overcasted. When expenses are overcasted, profit is undercasted. So correct it by adding back. which we were given as per note number 2 or number 3 there. I remember. Number 2, we were given down there that the depreciation charge for the year was 2780, sorry. 2780 according to note number 2. Good. We add back 2780. Listen. Listen to another challenge. Listen to another challenge. I want you to answer me now. For my sake, I may request, sir, you explain to me such a situation where you are not given 2 out of the 3. Humble request. I said, I will expect you to tell me that in the next lesson. So, Vincent, it's a challenge. We are not doing it for the first time. We have done a question in class. So I expect you to remind or to remember. Not, you will tell me in the next lesson. Okay? It's not hard, but it is something that is possible. And by the way, listen to this. Listen to this now. For those who are doing financial reporting, this is a topic you must understand. Those who are doing financial reporting of the intermediate, this is a topic you must understand. Why? Because it is tested again when it comes to advanced financial reporting. We only develop the topic, but otherwise the concepts we are discussing are the same concepts you will find when it comes to advanced financial reporting, topic of cash flow. We only add some other areas that you not cover at the intermediate level. Sour. Good. So let's continue. My question is this now. Listen. Because this again not something new. We said it in class. Among the non-cash items. Listen. Among the non-cash items, 2 among the non-cash items, 2 of the non-cash items will never miss in any question. 2 non-cash items will never miss in any question. Others may be there or may not be there in any question, whether at the intermediate level or at the advanced level. So, one of the non-cash items, reminding you, which you will always find out in any question, is the depreciation charge for the year. That is something you will always find in any question. Now, tell me this. What is this other non-cash item that you will never miss in any question? I said 2 non-cash items are things you will never miss in any question. So it means when I'm doing a question on cash flow, I automatically know they will be there. I don't have to struggle remembering them. Thank you, Vincent. Thank you, Vincent. You are there and you are the one asking a lot of other questions. Thank you. Thank you. Finance cost. Good. Finance cost. Thank you, Vincent. Finance cost is another item that will never miss in any question. Listen. And the good thing about finance cost, it's a figure you just go and pick it from the income statement. Listen. Whatever the question has charged in the income statement as the charge for the year, for finance cost, that also, we said, is considered as a non-cash item. Okay? It's also considered as a non-cash item. So, that's something you should not forget. So, which means, you go to the income statement, it will always be given. You don't have to calculate it. It's not like depreciation where if it's not given, you have to calculate it, but it will always be there. But when it comes to finance cost, you just pick it from the income statement. And according to this income statement, if you can see, during the year, the company charged the finance cost of 1,200. Listen, that was the charge, not the amount paid. Listen, this 1,200 was the charge for the year. It may happen that it is also the amount paid, or it may not be the amount paid. But as far as the income statement is concerned, don't forget, we normally prepare our P&L account on a concept we call accrual concept, where the concept states you recognize costs when they are incurred, but not when they are paid. Okay? So whether they have paid it or not, the charge that is in the P&L account is the charge for the year, not the amount paid, the charge for the year. Whether they are paid or not, that's something we shall ask ourselves later. Whether they have paid it or not, we shall ask ourselves later. But for now, the charge for the year for finance cost, just remember, it is always considered as an uncash item. The charge the year. I don't have to go back into the illustration that we did when we were doing the topic. Okay, good. So we come and say you add finance cost 1,200. We debited P&L account with that figure, yet that is the charge for the year. So let's now go and get other things. Listen to this now. Let's go and identify other non-cash items. Other non-cash items. How do we get them? Listen. To get other non-cash items, listen to this just as a reminder. You go back to your income statement. From that income statement that the examiner has given you, sometimes you may see in that income statement some items that are not that are not items by cash, meaning they are non-cash items. Some questions may have them in the income statement, some may not have them. So it's normally important to go back the income statement and check. To get this profit, they are calling 46.65. To get this profit, they are calling 46.65. Is there any non-cash item they have shown me there? One of them is that finance cost. You can see it in the income statement. Is there any other? Let's go back to the income statement. Hope you can see from this income statement, listen, to get this profit, we are calling 46.45. They got it by taking the operating profit, 55.40. They charge finance cost of 1,200. We have already agreed finance cost is an non-cash item. Then they have also included fair value gain on investment. Fair value gain on investment. You remember, when we were analyzing the account of investment, there was a gain on revaluation, listen, which the question told us that the investment are measured at fair value through P&L. So that 325 gain on revaluation of investment, it's not something we received by cash. We never received it. It's just a gain that we took to the income statement, yet we never received that 325 gain. So that's another thing that the company used to determine this 46.65 profit, yet it's a non-cash item. Come and now say here, come and less. Remember, it's a gain, and yet we never received it. So it means from the cash point of view, it made our profit more than it should be. Are you there? It made our profit more than it should be. So we come and say a gain on revaluation. This is gain on revaluation of investment. Just to remind you, gain on revaluation of investment. 325. We remove it. We remove it. Move it. Listen. Listen. So, I've said, take the profit before tax, identify the non-cash items. 2 of them are a must. One is depreciation, finance cost. Okay, good. Then I've said, go back to the income statement, see whether there is any other non-cash item. From this question, yes, that gain on revaluation of investment. In some questions, you could find gain on disposal, loss on disposal. You use also such items. This question, there was nothing else. From this income statement, I can't see anything on top of 46, which is non-cash. Only those 2, finance cost and the gain on revaluation. Good. So it means, listen, it means that I am through as far as income statement is concerned in identifying the non-cash item. Once you do that, go back to the additional information. See whether there is any other non-cash item you could pick or from your workings. That's what we want to do now. From the additional information, is there any other non-cash item we could pick? Note number one, there was a gain on revaluation of property by 4.5. Listen, I have already explained to you so that you don't tell me again that is a gain on revaluation. It's an non-cash item. I told you, as much as it's true, it's an non-cash item. Did it affect the profit? The answer is no. I told you the reason is because when you revalue an asset, you debit asset and you credit revaluation. Instead, we normally don't debit asset and credit P&L. If we were debiting asset and crediting P&L, then you could say it affects profit. But the double entry is you debit asset, you credit revaluation. Revaluation goes direct to the balance sheet. It doesn't go through P&L. Are you there? Good. So for number 1, we can pick nothing there in P&L account concerning non-cash. Number 2 is depreciation, which we have done. Number 3, we were told a new plant was acquired at 4 million. You remember, listen, you remember we had to analyze the account of intangible asset to help us determine the amortization. And there was amortization of the intangible. It's another non-cash item. Let's pick it. Come and add amortization. Let's go back to where we did the workings. What is it that we got as the amortization charge? Here it is. And the amount is 540. That is 540. It's an expense, so it must have made our expenses more than it should be. We add. Good. That is from note number 3. Number 4. Wamesema investment held by this bidder limited was measured at fair value less fair value through P&L. We have already identified the gain on revaluation and we have already used it. Good. It looks like now we are through with the non-cash item. Are you okay? Looks like we are through with the non-cash item. So once you are identifying all of them, get the totals. Don't forget, listen, don't forget there could be many others. Impairment is another non-cash item. Gain or loss on disposal will be another non-cash item. Provision for bad debts will be another non-cash item. Bad debts are also non-cash item. I hope you know that because we are not doing it for the first time. Good. Those are some of the other non-cash items which are not part of this question. But you never know. In another question, they may be there. Okay? Good. Let's continue now. What we do, we get the totals. This is 4665. plus 2780 plus 1200 minus 325 plus 540. Hope you are getting the same as mine. I'm getting 8860. 8860. And that's what we normally call cash flow before. We normally call it cash flow before working capital changes. Cash flow before working capital changes. Cash flow before working capital changes. Then we now go bring in the working capital items. We now go bring in the working capital items now. Those are the items I said we did not need to put down the workings for, like stocks, debtors, creditors, you know them. So let's go back to the question and find out. Let's go back to the question and find out whether debtors were increasing, stocks, creditors, and so on among the working capital items in the balance sheet. I can see we have stocks, which are inventory, and our inventory was increasing. So let's put down andika somewhere increase in stocks or increase in inventory. Increase in inventory. Last year 70-40, this year 74-85. So we are getting 74-85 minus 70-40. 74-85 minus 70-40. What does it give us? 74-85 minus 70-40. This gives me 445. For stocks to go up, obviously, for stocks to go up, you must have purchased some more as a company. That is an outflow or a negative. Let's go to debtors, or what we call accounts receivable. Let's go to account receivable now. Last year, the amount was 58.30, sorry. This year, 60.35. So let's do the same. Looks like another increase. We come and see an increase in accounts receivable. Increase in accounts receivable. Let me take this year 60.30, sorry, minus 58.30. Looks like an increase of exactly 200. Yes. 200. Again, listen. You all know that if our debtors went down, the company must have received 200. If the credit debtors were going down, then it means we must have been paid by our debtors. So that would have been an inflow. But now there is an increase, automatically another negative. Good. That is a negative. We move on. After debtors, you know we normally go to cash in the balance sheet. After debtors, we normally go to cash, you know. But I told you, we don't analyze cash the same way you analyze debtors and creditors. No. I told you, it has its own place in the cash flow statement, so we leave it. So it means now, listen, means I'm through with the current assets. Among the working capital, we are through with the current assets part of the working capital. We now go to the creditors, which are the current liabilities. So we are given down there accounts payable. Last year, 35.05. This year, 46.45. Another increase. So put it down. Increase in accounts payable. Increase in accounts payable. Increase in accounts payable. We are getting the difference, 46.45 minus 35.05. Let's calculate it. 46.45 minus 35.05. I'm getting 1140. Getting 1140. Again, you know, listen. Again, you know, if the creditors were going down, assuming there were decrease in creditors, it means we would have paid them. It means we would have paid them. That would be a negative. But now there is an increase in creditors. Of course, the opposite, the reverse is true. This will be a positive amount. This will be a positive amount. Good. So we are through with the working capital items as per this question. We have analyzed the stocks. We have analyzed the debtors. We have left the cash. We have analyzed the current liabilities. Among the current liabilities, there is only working capital called creditors. Good. Let's get the totals. Let's get the totals now. So I take that 860 plus, not plus, minus 445 minus 200 plus 1140. If I'm correct, I'm getting 93.55. 93.55. If I'm correct. 93.55. After that, we go to what we normally call tax paid. You know that. Which we already computed. Let's go and pick the figure we were calling the tax paid. Where did we use that working? Where did we get it? Here it is. Our workings for the tax paid was 520. Let's pick it. 520. We get the net. That is the figure we are calling cash flow from operating. So we minus 520. I'm getting an amount of 88.35. Push it to the extreme. Push it to the extreme. And because it's a positive amount, we normally call it net cash inflow from operating activities. It's a positive amount, call it cash flow, net cash inflow. If it was a negative, you would call it net cash outflow. Otherwise, it's a positive, you call it net cash inflow from operating activities. Good. I think we are through with the first category, and that's the major category of the cash flows. That is the major categories in terms of workings. The others for investing and financing, those ones are not technical items. No. So let's go to the second category now. And we come and identify our cash flows from investing activities. Cash flows from investing activities. Okay. We all know investing activities are those transactions that affect, listen, those transactions that affect a fixed asset or what we can call non-current assets. Any transaction affecting a non-current asset that is the transaction we classify as an investing activity. Could be you are buying some fixed assets, selling fixed assets. Like in this question, you remember, our first analysis is where we did the determination of the cash paid to acquire property, plant, and equipment. Good. Let's even identify it. Purchase of PPE. We prepared the account called property, plant, and equipment, and we had to use it to determine the cash paid to acquire new ones. It was the first workings. Let's go back to where we did the workings. Good. I can see it here now. We got an amount of 16,595. 16,595. Bring it. 16,595. And remember, we are buying. That's an outflow. That is an outflow. Good. After that, we are still looking for any other transaction. Listen, any other transaction affecting our non-current assets. So which means to know, listen, to know which ones are there, you can go back to your balance sheet and check which non-cash items, which non-current assets did we have. Like in this balance sheet, I can see among the non-current assets, we had property, we had intangible assets, and we had investment. Those were the three non-current assets. So anything affecting them will be classified as an investing activity. The second item in the balance sheet was intangible, and you remember we were specifically told by a note somewhere that we acquired some intangible assets called patent. By how much? By 4 million. That's already something we were given. We did not need to calculate it. So we just pick it. We'll come and say a purchase of intangible assets. Purchase of intangible assets, 4 million. 4 million. Okay? From the same balance sheet, the next one was investment, which we saw was revalued through fair value P&L. So we saw we did not buy any property, any investment. We were told neither purchase nor sale. Neither purchase, sale of investment occurred during the year. So we did not buy any new investment. Good. Then from the additional, I can't see any other information. There was nothing mentioned in the additional concerning disposal of an asset, like machinery, motor vehicle, nothing. Otherwise, if they are there, you would have brought them. Good. So it looks like, listen to this now, looks like we are through with our investing activities. We must have purchased some property. We must have purchased an intangible asset. I have said there was nothing like disposal of an asset. Otherwise, they should have given us a note. We also said, we are specifically told there was nothing like purchase or disposal of investment. Nothing. Those are the only items we can pick. Let's get the net and we push it to the extreme. 16,595 minus 4,000. I remain with a balance of how much? No, we purchase, we purchase is a negative. Sorry. Make that correction. We purchased an intangible asset. That's a negative, not a sale. If it was a sale, we would be receiving. We purchased. So we are ideally adding the two negatives. That automatically comes to 20,595, a negative. 25.95, a negative. Push it to the extreme. Push it to the extreme. And if it's a negative like it is now, you call it net cash outflow. Net cash outflow from investing activities. Net cash outflow from investing activities. Net cash outflow from investing activities. Good. We now go to the last category, And that's what we call cash flow from financing activities. Cash flows from financing activities. Again, here is nothing much difficult in identifying the investing activities. The financing, sorry. And what are they? These are transactions that affect the finances of the company. You remember we analyzed the account of share capital. Let's go on somewhere, say issue of shares. We had to analyze the account of share capital and share premium. So let's go back to where we did the analysis. What did we get? Yes, there was this balancing figure, which we got as share capital and share premium, a balancing figure of 12,500. Let's record it. There was issue of shares amounting to 12,500. That, of course, is an inflow. Then you also remember, listen, you also remember that we said you don't have to analyze the account of long-term borrowings because we saw the loan was increasing, and so we concluded there must have been some additional loan. Come and bring it, additional loan. We did not need to analyze that account, so we can just go back to the balance sheet and see by how much did we increase our loan by. Last year it was 10,300. This year 11,600. Last year it's 10,300. This year 11,600. So 11,600 minus 10,300. That's exactly 1,300. That's the additional loan. Good. From this question, let me explain something there. This question, if I look at the balance sheet, among the finances of the company, we only had share capital and long-term borrowings. We did not have things like debentures. We did not have things like debentures. Otherwise, there could be additional issue of debentures or no, or repayment of debentures. Good. Now listen. Once you have identified, I want you to listen now. Once you have identified the major financing items, which I've said like share capital, additional loan, could be debentures. Now, once you have identified that, now listen, any return you pay to the financiers, any return on investment that you normally pay to your financiers as a company, that return on investment that they have provided you, these guys are provided with finances, they expect a return. The loan providers expect a return called interest. Debenture holders normally expect interest on debentures. The shareholders expect a return called dividend. Those returns that you pay to your shareholders, we normally also classify them as part of financing. So among the other financing items, we normally identify are the dividends paid. We pay dividends to the shareholders. They are part of the financials. So whatever you paid them this year as dividend, that should be classified as a financing activity. Good. So let's go back to where we did the calculation. We had to work backwards. You remember, we had to work backwards to get the dividends paid. And I can see here, we paid them dividends of 585. Good. Pick it. 585. The payment, so we put it in bracket. The payment, we put it in bracket now. Good. Now listen. Now listen, and this is important now. To the loan providers, there is interest paid. Listen, because that's a bit technical now. It's a bit technical now. Of course, some of you can remember, because we must have mentioned this when we were doing the question topic. Listen. Listen. I told you in the income statement, where is it? In the income statement here, you can see this figure called finance cost. Finance cost is automatically part of interest. That time, I told you it was considered as a non-cash item. I also told you it is something that you may have paid or you may have not paid in terms of interest. But you charge the income statement with 1,200 as finance cost. But how much could you have paid as a company? How much out of it could you have paid as a company? Whatever you paid during the year as interest, that's what you bring here as interest paid. Listen. So it's now your responsibility to ask yourself from the question, how much did we pay as interest? From this question, somebody now tell me, what do you think? How much did we pay as interest? Somebody to put down the note. How much did we pay as interest from this question? How much did we pay as interest from this question? So far, we are finishing. So it is also possible to know how much did we pay as interest from this question. I expect you to know how to determine or how to know. So how much did we pay as interest in this question? Yes, somebody to chat. How much did we pay as interest? We discussed this in the class, last lesson, last time. Good. Thank you, Lois. Good, Lois. Now listen. Thank you. That's correct. Thank you. Now, for the sake of the others, let me explain. For the sake of the others, how do you determine how much you paid? I want to explain it. Oh, sorry. Now, how do you determine or how do you know how much you paid? Now, I want you to listen. In our P&L account, we have charged interest there of 1,200. Listen. It may be possible that you could have gone through the question and find out in the balance sheet. I'm doing an illustration not to answer the question. I'm trying to explain. Suppose in the balance sheet, among your current liabilities in the year 2024, 2023, suppose you could have seen accrued interest. Suppose you could have seen accrued interest of, let's say, 2,000 or maybe 500 and let's say 600. If there was accrued interest in the balance sheet, then to determine how much you paid, you would do this. You would have opened an account called interest. You would have brought down the balance by the beginning of last year, which is that 500. Then you would have gone to the income statement, pick the charge for the year, which is in this case is 1,200. It's normally debited in the P&L account. Automatically, it means you would have credited this account, 1,200, with the charge for the year. Then you would have carried down the balance by the end of this year, which in our illustration here is 600. Then automatically, the balancing figure is what you must have paid. That's how you determine the amount paid. And in this case, this will be 1,700. This will be 1700. So you would have come and said here, cash paid 700. That's what you would have done. Listen, if you went to the balance sheet and you saw in the current asset section, current liability, there was accrued interest, then it will force you to open the account called interest account. You would have brought down the accrued interest by the beginning. You would have carried down the accrued interest by the end of the year. Then you would have gone to the income statement, pick the charge for the year, which in our illustration is 1,200. And because it's normally debited in the P&L account, automatically would have credited the interest account. Then from there, you would get the balancing figure to represent how much was paid, which in this case, 1,100. Now listen, from our balance sheet as it is given in the question, there was nothing like accrued interest last year or this year. Listen, there was no accrued interest last year or this year, which automatically means that the accrued interest last year was 0 here. So even if I was to prepare the account, the balance brought down would have been 0. The charge for the year would have been 1,200. Then I would have come and said here, balance carried down. From the balance sheet this year, there was again no accrued interest. So I would still have carried down 10 because it's not there. Then I would have said, if the balancing figure is 0, the charge for the year is 1,200, and I'm carrying down a liability of 0, I must have paid 1,200. I must have paid 1,200. Listen. So we identified, or somebody, you remember Lois has given us the amount of 1,200 because she must have looked at the balance sheet and realized there was no accrued interest. So it means the charge for the year, which is this 1,200, must be the same amount you must have paid during the year. Are you there? Otherwise, if in the balance sheet there was something like accrued interest, we would have been forced to open the account called accrued interest. But in this question, there was nothing like accrued interest in the balance sheet. So it means it was 0, the charge for the year being 1,200, and there was nothing carried down as accrued interest by the end of the year. It means we owed the loan providers nothing. So automatically, we must have paid them the same 1,200. So when you don't see, listen, when you don't see any accrued interest in the balance sheet, then it means whatever is the charge for the year must have also been the same amount you paid during the year. So it's the same 1,200 that you must have paid. Are you there? Good. That's what we are saying. So for this question, we only had to identify the amount paid is the same 1,200. Why? Because there was nothing like accrued interest. Otherwise, I've explained in some questions, you go to the balance sheet and you find there's an accrued interest at the end of the year. So you would have determined. But for this question, there was no accrued interest. So the same charge for the year becomes the amount paid. Good. Let's put it there now. Good. And therefore, we are through. So we are through. Now we get the totals now. We are through. Get the totals now. We are through. We get the totals now. So I can't remember any other financing activities. We have identified the share capital, the loan. I said there was no debentures. Once you have identified the major items, now you come and pay the returns to the financials. Shareholders, how much did you pay as dividend? Interest, how much did you pay as dividend? Those ones you have to identify. Good. So now we get the totals, 12,500 plus 1,300 minus 585 minus 1,200. I'm getting a positive 12,015. Put it on the extreme, 12,015. And being a positive, I call it net cash inflow. Net cash inflow from operating, no, in financing, sorry. Net cash inflow from financing activities. Net cash inflow from financing activities. So we have identified the three categories now. Good. Now we get the totals of the three categories. You know the structure of cash flow now. So let's get the totals of those three categories. What we got as the operating, the investing, and now the financing. Good. From the question, I can see the operating was up there, 885. No, 8,835. Our investing was here, negative 20, so I minus 20, 595. I go to financing, it's a positive 12,015. In total, I'm getting a positive again. Sorry. I'm getting a positive 255. 255. You remember we said when we were looking at the topic, you get a positive, we said you call it increase in cash and cash equivalent. Call it increase in cash and cash equivalent. Then from there we said, once you get increase in cash and cash equivalent, we said you come and add opening cash and cash equivalent. Add the opening cash and cash equivalent. Cash and cash equivalent. Where do you get it? You go to the balance sheet now. This is where I was saying you don't have to analyze cash flow or cash balances. This is where I was saying you now go pick it. Now go pick it. Let's go and pick the balance of cash, the balance sheet last year. This is where we said you don't have to analyze cash and cash equivalent. From this balance sheet last year, I can see the cash was 2230. Are you seeing it there? 2230. Good. Get the totals. That looks like 5,842. 2485. That being the total, you call it closing cash and cash equivalent. Closing cash and cash equivalent. So you have to confirm whether it's reconciling with what you are given at the end of this year. Finish. Go and confirm whether it's reconciling with our cash balance at the end of this year. We want to confirm whether we have the same for 2485. Good. Same. You can see it in the cash flow, in the balance sheet, sorry. Come the end of this year, we have a balance of 2485. It means we have reconciled our cash flow. Good. So we are through now. Through with that question now. Yes. Vincent says, sometimes I use, it's reconciling and well done. Well understood. Sawa. Vincent sometimes says, I use interest paid as part of operating, even dividends, not dividends. Interest, yes. Interest, yes. But dividend, listen, Vincent, dividend, yes. But no, interest, yes. But dividend, no. Dividend will always remain financing. But, sorry. So what I was saying, Vincent, is this. That when it comes to cash flow, IS number 7 allows interest paid to be part of operating. Why? Because they say you are borrowing for operations of your business. You borrowed for operations. Where we normally have here interest, tax paid, you also can bring here interest paid. Because you borrowed for operations. So that's allowed. But you can also argue by saying you borrowed to finance the business. So interest paid, it's allowed. You can treat it as part of operating, or you can treat it as part of financing. But dividends should be considered as part of financing. These are shareholders, investors. Investors get a return. They don't provide money for operations. You can go and borrow working capital for operations. That's why we consider it as maybe part of operating. But for shareholders, you borrow for long term, and therefore dividends are considered as part of financing. But interest is allowed. You can classify it as part of operating, but not dividends. Dividends should always be classified as part of financing. Are you okay, Vincent? So dividend, financing, interest, either operating or financing. We allow those two arguments. Okay. So now that we are through with the question, allow me to stop there for today. We have taken too much time. I wanted to finish the question. But maybe before we finish, let me put down this. Let me say this. Please tell your friends. Please tell your friends that we have online classes for advanced financial reporting of the advanced level. Tell your friends we have online classes for financial reporting of the intermediate level. Please tell your friends that we have also online classes for financial management of the intermediate level. Tell your friends that we have online classes for financial accounting of the foundation level and the one of ATD1 and ATD2. Good. Tell your friends that if they cannot be able to join the live class, they can still buy the pre-recorded videos for the whole syllabus and watch the videos at their own free time. Okay? Those are the 4 subjects we are offering online classes for. Tell your friends that they can join either live class or buy the pre-recorded videos. We can be reached. Somebody can get me through this number, 0722 65 8875. 0722 65 8875. Good. Another thing is, some of you are watching me through YouTube. Please, you're watching me through YouTube and you have not subscribed to my YouTube channel, click that subscription button and subscribe. Down there, there is a subscription button. Please click that subscription button and subscribe to my YouTube channel so that you may be notified whenever we post new videos into the YouTube. Okay? Please subscribe to my YouTube channel. Of course, the name of the YouTube channel is called CPA Joseph Njuguna. That is the name of the YouTube channel. There are many other videos there that you can see for promotion. You go to that channel, you will also find some of the videos which are there for promotion. So if you need, go to get some more videos for promotion purposes that I've posted there for promotion, then you can go there. So please tell your friends that we have those online classes for those 4 subjects: advanced financial reporting of the advanced level, financial reporting of the intermediate level, financial management of the intermediate level, financial accounting of foundation level, and the one of ATD1 and ATD2. Then I've said, if they can't join the live class, they can buy the pre-recorded videos where they can watch the videos at their own free time. And I've said they can reach me on this number, 0722 65 8875. You need the country code because it will be 254 722 65 8875. If you need to use the country code, That is 254 722 658875. Maybe for now we can stop there. Pick it up from there next time. Pick it up from there next time. Unless somebody has a question. Unless somebody has a question, we can stop there for now. Or even a comment. Somebody can give us a comment. Somebody say, Kada, you have understood. Have you understood the topic for now? Those who have joined us. Are you okay? Have you understood the topic? At least. Somebody give us a comment. Somebody can give us a comment. So Faith say, yes, you have understood. Thank you. So even if you are here and you wish to continue with us, you can call me on that number. You are here and you wish to continue with us, and call that number. Any other comment? Faith says he understood. Good. Thank you, Senior. Be blessed. Sawa, thank you. Okay, fine. So unless there's something else, we can see you in the next lesson. Okay. I want to close for the class. Unless there's another comment. Bye for now.